Hello, friends, and welcome to the Optimized Advisor Podcast, where we focus on optimizing the well-being and best practices of insurance and financial professionals today. On this show, our objective is to help you optimize your life, optimize your profession, and learn from other optimized advisors. I'm your host, Scott Heinela. We hope you enjoy the show. Welcome. Thank you for coming in today.
Thank you.
As Nick Bernatowicz just said, it's so fun to have you here today.
It's great to see your new digs. That's fantastic.
It is. We're moving on up, down south, some direction. Anyways, here we are.
As long as you keep it warm.
That's right.
Somewhat warm in the winter. That's
well,
nice.
we turned on the furnace for you here for the next few days. At least for tomorrow, it'll be 75. And
yeah, I appreciate that.
Yeah. Brian Ott with 525 Advisors. Thank you for joining us in the Optimized Advisor podcast today. You, my friend, epitomize what it means to be an optimized advisor. And I do mean that sincerely.
Thank you. Glad to be here.
I would say nobody does it better than you as it relates to the topic of long-term care planning. The numbers and your performance speak to that pretty clearly and concisely. Not that there aren't others doing it as maybe as good and fair and respect, but probably not anybody's doing it any more efficiently or more productive than you are. Would that be fair to say?
I don't know.
Not to be boastful. That's
Yeah.
not the point. It's
Yeah.
validation.
And we've definitely created a niche. There's no doubt about that.
So can we talk a little bit about that?
Yeah, let's do
And then we'll dive into the history of long-term care insurance,
Okay.
why everybody should have it,
Absolutely.
but very few actually do.
Why everybody wants it.
That's a very good statement. Make note of that.
Make
Also,
note.
Nick, welcome to be
Yes.
here today.
I was just thinking when Brian was saying that, and you were saying, you know, he's has his niche, as I would say, not niche. Not many advisors do that anymore. Most advisors dabble in many things, right?
Yes.
And they try to be everything,
Right.
rather than just truly be a specialist. So I think it's refreshing, and it probably helps why you're so successul and so passionate at what you do, because
Yeah.
you're a specialist in that
Well,
field.
look what we've done. When I was a kid, I grew up in the 70s. In our little town, we had a jewelry store, we had a sporting goods store, we had a hardware store, we had a J.C. Penney's, we had a butcher shop, pharmacy. Then all of a sudden, Walmart comes to town and they start doing all these things. And that kind of happened in the financial services world as well, too, right? We used to have our banker, we used to have our stockbroker, we used to have your insurance, probably a home and property casualty insurance agent, and then probably a life agent. And then everybody decided they could consolidate. They could all bring it under one roof. The banks wanted to play, the insurance companies wanted to get into assets under management. And so what happened is just what you're saying. I think we've lost that specialty in that because we're trying to do everything. And I think it's a valid point that you're starting to see. I love, like, I'm starting to see some cheese shops open up and like the little butcher shops coming back, and these bread shops where it's just they specialize in a product now. And that's kind of what I'm hoping we start to see a little bit more in financial services. Some of the real experts step out and just say, I'm going to focus on something.
There's some interesting points that were just made. One, what I take from that, and what's interesting about that is I'm very entrepreneuristic, right? And so are you. Otherwise, you would not have taken the risk that you did
Right.
to build the business that you have. And we'll get a little bit into that. And that's not uncommon. The challenge of that is individuals by design, by how we're wired, are always like shinier, brighter. My wife always gives me the hard time. Oh, squirrel, you know. And there's a good to that, but there's the trade-off is you end up deteriorating your quality, spreading yourself further and further thinner, and so. That's the one takeaway.
Right.
How do you say, and put a pin in this, how do you stay acutely focused, even though you are, I would say, a risk taker and you are an entrepreneur? The other thing that I would take away from your comment is use the butcher example. Mm-hmm. It's almost like the marketplace, the quality of the resources have to deteriorate to such a state. So use that as an example. The meat in your grocery store have gotten to such a poor state that we now have butcher shops making a resurgence because consumers are gaining access through Snake River, let's say nationally speaking, to deliver to your door like the highest quality meats. No. Yeah. I still want to go back in. I want to go get the best meat in my community. I want to walk in because tonight I want to have steak, damn it. And I don't want to have to order it. So it's interesting that you made that comment, because I think in financial services, to that end, it's like many of the planning solutions, the advisors are caught up with the fact that I need to try and do too much, as opposed to being disciplined and saying, no, I'm going to do really, really good at this one or two or three things at most.
Yeah, we're taught that we can do it all, right? You go through any training program through anybody, go to one of the corner RIA shops out there, like an Edward Jones or something, go to one of the big mutual insurance companies. Their training program it covers it all. They teach us that we can do that. And they spend a lot of time practice your elevator speech. And then once you get that conversation going, you can get them a mutual fund, you can get them some insurance, you can get them some, roll their IRA over, whatever it is. We're taught that we can do all of it. And going back to the question, like, how did I decide I'm just going to focus on that? Well, I remember reading in a book.
And took incredible risk to do that, by the way.
Yes. And, part of it was, let's go down the insurance list. Let's pick the hardest one, long-term care, the one that the fewest people want, the one the fewest people want to talk about. It's like, okay, let's go with that one. So, but just for me, what motivates me, I remember I had a neighbor that was they were into Amway, which I'm not sure what the parent name, they changed the name to Amway. But anyway, like multi-level selling, whatever. And they came up and they were just trying to talk to me, get me excited. I was just moving in. I've got my arms full of boxes. And they're asking, what do you do for a living? And we'll show you how to do some stuff on the side. And I said, well, I haven't mastered what I'm doing right now. And so when I master that, I'll look for a second job. And so I always tell myself that, have I sold all the long-term care insurance I can sell? And the answer is no. So when I say yes, I've hit the pinnacle, I've reached out, okay, let's look into something else. And I think that's part of what you really have to look at, as opposed to saying, okay, well, I'm doing okay at long-term care. Why don't I add annuities in? Or why don't I add life insurance in? Or why don't I, open up this other business or something? A lot of people, like you say, you can get distracted on that, and it just takes time. And it's hard. And versus just saying, hey, I'm going to put both feet in this. I'm going to learn and master this.
Can I ask you what your thought process is when somebody, and I'll say like me, who's saying, you know what? You're sitting on a gold mine. And you have to stay within the guardrails. And I do really respect that. Although, and now here's me again, squirrel saying, come on, you can do.
Yes.
And you're saying, no.
Entrepreneur.
I have a check. I am. Yeah. I mean, I'm just interested in new things. It's not about me. This is about you. What is your thought process truly of like, no, I've got to stay within the guardrails, as challenging as this may be at times. There's a better way. I can still optimize.
Yeah.
And I need to focus my attention on that.
I look at it from a time constraint, first and foremost, because if I'm going to talk to a client about any product, I really need to know that product. So coming back to Nick today, saying, hey, I've got this life. I was talking to him today. I didn't even offer to give him a quote or anything. I said, you know what? I'm going to go talk to my life guy. I'll get back to you in a few days. And so you realize that there's a lot to learn, a lot of nuances on all these products. And so for me, I sat there and said, yeah, I could do that, but can I do both at 100%? No. So which one am I going to try to do both at 50, or am I going to do one at 80% and one at 20%? And so that's what I always tell myself. Now, the flip side, what you're seeing, I'm not going to say you're like guilty of this, but it's, yes, I've got this book of business, but maybe that book of business needs to be introduced to some other things out there. So we've talked about that. So we're talking about that maybe, but would I be in a better position to bring somebody in
to do that
and let me stay focused where I'm at? And that's a tough call, because you get an insurance license. Well, I can do this, this, and that. And why not do this, this, and that? And we do dabble outside of it a little bit of long-term care. It's like a little bit of life, a little bit of disability, but those are onesie twosies. And that's where I'm usually passing the buck to somebody, just saying, hey, can you help me with this?
Okay, last thing and then we can move on to from this is, it's interesting you make the comment, you looked at the list of insurance and you joke about the fact that I picked the most challenging one. Where you came from was what business?
Mortgage business.
Mortgage business. Yes. So I can argue everybody who owns a home needs a mortgage.
Sure.
So that's a product that essentially sells itself. Like, at the time too, it was probably so easy to sell mortgages.
Yeah. In retrospect, yes.
And then now it's like, no. I'm going to pick the hardest thing to sell that nobody needs.
The joke is with my wife. What were we talking about the other day? I said something in the kitchen. I said, how cool would it be to sell something that somebody actually wants to buy? And she's like, you would kill it, honey. And I'm like, yeah. I mean, how cool would that be, right? So I laugh about that. But the mortgage business, we had talked about this in the past. There was a lot of similarities to it where it replaced health underwriting and insurance with credit underwriting. But we were, for years, I started back in the 90s, have been in a refinance boom for decades, right? Taking people down. So really what it was, we were just selling rate. We were consolidating, helping consolidate bills, save money. And that was the process. And so really most of that sales issue was it was rate sensitive. People were buying rate. People were shopping rate. Could you match what somebody else's rate was? That's what it always boiled down to, and the closing costs. And so going in, but you didn't have to educate somebody to what a mortgage was.
No.
They knew what it was, and they knew why they needed it, right?
Well, I think this serves as a great segue, transition. So why is long-term care insurance so difficult? Why is it so hard for people to wrap their minds around the idea of having to buy it? Where did it start? Where have we evolved to?
Yeah, that's a great segue of like, okay, let's go back to the beginning. We'll just talk
Yeah.
about what was long-term care insurance meant to be.
Yeah, so let's go back to the 70s. My great-grandmother was 86 years old, living in her home in a little town in Creede, Colorado. The family was taking care of her, and then her health was compromised to the point they couldn't take care of her. Put her in the car, they drove her down to the nursing home. And she spent less than a year in that nursing home. That was the end of life care. So that was very common. And so Medicare came out in 65, long-term care insurance really in the mid-70s. And it was originally that Medicare supplement, because Medicare will say, I'll pay for 100 days of skilled nursing. They said that back then too, if the doctor's medically necessary. And it was a lot easier back then, like to get someone like my grandma, doctor say, yeah, we'll put her in the nursing home. But my point was, we've talked about this, that who was that policy designed for? Is the middle class. The poor people were going to go to Medicaid. The wealthy people could pay for their own nursing home.
Mm-hmm.
Who did the insurance companies market that product to? That lower to upper middle class range, whatever that
Right,
was.
the ones in
middle class.
between.
Right. And that has stuck around since then. And so what that did, that simple act of that back in the day, if I have enough money, I don't need to worry about it. It's not about planning. It was simply a way to pay for nursing home cost. It was nursing home insurance. That's what it was called. So fast forward here, we've evolved. Now we have assisted living. We have the home health care, the fact that 3 out of 4 people start their long-term care journey in their home, which is like my great-grandmother did. It's just that they had family members around them to provide that care. And so here we are in this situation where we're still looking at it. That's that hangover effect, I call it. That it's simply about money. Wealthy people don't need to worry about planning. They've got enough money to pay for whatever those costs are. Middle class, well, they may or may not need it. And right, so that's where the advisors come in. I think you're okay. We've got some magical number, whatever that is. And then the poor people are going to be on Medicaid. That's still the same. So over the last 40 years, who's been left out of that education or that conversation? It's been the wealthy.
Mm-hmm.
The people that supposedly have enough money to pay their own way don't get told about the benefits of long-term care planning, about the tax savings, about the guaranteed leverage, about the access to the team of professionals. That's all. Why don't they? Well, because you have enough money. Right. So that's really I think the headwind we're going into from advisor point of view. I don't want to talk to Scott about long-term care planning because he's got $10 million. He doesn't need it. I'd look like a fool if I bring that up. I don't want to talk to Nick about long-term care because he's doing okay. He's got a few $1 million and I'll just insult him. So we won't worry about it.
One of the things I feel too, and you probably the same, is a lot of advisors don't want to have that personal conversation either, right?
Right.
It's just not dollars and cents when it comes to long-term care, right? There's a personal aspect, an emotional aspect to the discussion around it. And it tends to have advisors shy away because they don't want to get that deep.
Mm-hmm. No. You're spot on. That's hitting the nail on the head. It is a messy conversation. Statistically, if they go out there and we poll the public, 75% of the people think, 80% people think that long-term care insurance is good for other people. They should get it. But when they ask them for themselves, 90% don't think they're going to need it. They don't want it. And you don't want to see yourself in that position. I don't want to have to use it. And so then the advisors, and that's what so caught me when I was going through the training with this mutual company. We're talking about all these different things, and really they're an insurance company at heart, but it's easier to talk about this kind of sexy mutual fund over here.
Yeah.
It's got this beautiful yacht on the cover and da-da-da-da. But talking about long-term care and being incapacitated and being, being depending on other people to help you through the day, that's not a fun conversation. And a lot of people just want to push that off to the side, and we'll save that for a later date. We'll talk about that later, and they just never get around to it. So I think that's a valid point. From the advisors, there's definitely some hesitation there.
Okay, so from a planning perspective, product has evolved. We're not talking, it still exists, but the solution set today is predominantly what the industry would coin asset-based long-term care.
Yes.
And you and I are talking about, gosh, you are bringing it, that it shouldn't be called that, at least from a consumer's perspective.
Well, they're calling it hybrid, or it is the most common name, hybrid, I think. I describe it as an asset-based plan because in the sense that it's still an asset to you and your estate, right? The problem I think where we've got in the industry is we've got linked benefits, which is what the IRS is calling them. We've got hybrid, and the way advisors are describing is we have these new life insurance policies that we can use for long-term care.
Okay, so you do prescribe to the asset-based mindset is okay.
Well, yeah. So I was saying what caught me on your podcast is where we had advisors saying, so these new life insurance programs now that we can use, and they get the death benefit, but they can use them for long-term care. That's the language I think we have to be very careful with.
Because the consumers, I'm buying life insurance.
I don't need life insurance.
Or I'm buying an annuity.
I don't believe in annuities.
I'm not buying an annuity. I'm not buying life. Your point is,
yes,
you're really not buying this for life insurance and or annuity.
Yes.
You're buying this because we're saying you want leverage on your assets to help pay for care.
Yeah.
And that's why I like the term asset-based, because you're not buying, you're not purchasing, you're not using a premium. It remains an asset.
Yes.
Right? So the term I always, reallocation, right,
Yeah,
of funds,
repositioning
of funds, is a term I like to use a lot more than purchasing. And it seems to resonate more when you say it's an asset that you still have.
Yes. And if we go back, so there are just certain connotations. And I think life insurance, reverse mortgage is one of my favorite. It's like, I don't know what that is, but I'm pretty sure it's bad. Annuity, right up there. I don't know what that is, but I'm told never to get an annuity, right? And so we just have to be careful how we describe it, because it's not life insurance that we can use as long-term care. It's long-term care insurance that has a life insurance component, or it may have that deferred savings, that annuity bucket. And the easiest way I describe long-term care insurance as a bucket of money. What an asset base or what a linked benefit is, linking two buckets of money together. That bucket one is the asset, right? That's that life insurance component. That's that annuity component. Now, you can buy just that, but that's not what we're usually selling. 99% of them are going to have this second bucket attached. That's that continuation of benefits. That's just pure long-term care. So the idea is that with this asset-based long-term care, I have a defined bucket of money that's going to pay a benefit one way or the other. But if I use all that up, I also have another bucket of money that's going to extend that long-term care for up to a lifetime. That's what we're buying. And so the danger, I think, when you could technically buy a life insurance policy, you're just buying bucket one. But most of those policies will also be a chronic care rider. They're not even going to be long-term care. So it's not really long-term care insurance. And so that's why I say we got to be careful when we use that language, life insurance that you can use for long-term care. It's not really what it is. It's long-term care that has a life insurance component or a deferred savings. Most of them are life.
And listeners can go back to one of our episodes, and we did a long discussion on 101G versus 7702B. We did. The difference between chronic care riders and true long-term care.
I was just telling Scott that. So Limerick just put out this report, 227,000 policies sold in 2020, I think, or 2019. 2/3 of them were 101G riders, linked benefits. So that just tells me they're buying universal life insurance policies with a 101G rider. And the overwhelming majority of those, 90%, did not have a defined benefit because there's no charge in the front. So what that means is that, 20 years down the road, let's go to, I would say, picture Einstein in front of a chalkboard. That's their equation. And then they come up and they say, this is what we're going to charge you, and this is what benefit you're going to get. You don't even know.
Yeah,
So-
one of the only times advisors started seeing and understanding what they sold was when Washington passed the CARES Act, and they figured out that all these policies that they sold do not count.
They had a lot of upset clients.
They had a lot of upset
You
clients.
told me I have long-term care now.
Exactly
That's
right.
not going to qualify. And a lot of the advisors didn't even understand why. That's the sad part.
Which is amazing to me because when you actually look at the illustrations or the contract, it, in big, bold letters somewhere
Right in the
says,
front.
this is not
intended.
long-term, it's not intended to be long-term care insurance. You cannot, it's not what it is. And it clearly states that.
And the other thing is there is no place in the contract that will say long-term care insurance anywhere on a 101G rider. We'll never use those words long-term care. And here's what you're up against as an advisor. If I sell that 101G rider, that chronic care rider, and I tell somebody that, yes, this is their long-term care plan, and I've got an email that says, hey, your long-term care plan, and it's at Universal Life, I'm on the hook now as the advisor because I misrepresented that product. And they're trying to be very clear about that because the downside, going back, I know you guys have that whole episode, but the number one thing about a 101G rider you have to understand is that they're not all the same. Mm-hmm. It's not like a 7702 where it triggers off 2 ADLs or cognitive impairment. A lot of those 101G says you've got to be permanent. Okay, you have a stroke. Well, that's not a permanent situation for a lot of people. They'll heal up from that. It might take a decade, but it's not permanent. Mm-hmm. So that by itself, I just think is a danger area for the advisors. And that was such a good point. Washington State, when they passed that, and all these people thought they were covered, they had long-term care insurance. They didn't. They had a life insurance policy with a 101G rider. Mm-hmm. Surprise, surprise.
Yeah.
Right. So.
Okay, let's pivot to affluent individuals. Like we already know, those who don't have any assets, that's the predominant reason why there's government-provided care.
Correct.
Then there's those that are in between that probably need some form of insurance the most. But then there's the subset of the affluent and the advisors, why would they need to bother with this? That my client has $10 million of investable assets.
Right. So that's what I had an advisor tell me. So
how do we shift the mindset?
His theory was that my clients are $5 to $50 million. None of them need long-term care insurance. I said, nobody needs long-term care insurance. He goes, well, what do you mean? I said, think about it. No, who needs it? Mm-hmm. The poor are going to go to Medicaid. The middle class might end up broke, but they'll end up on Medicaid. They won't die on the bench. And the wealthy people, they don't need it. They can afford to pay their own, right? And he goes, well, I go, okay. I go, but your clients are going to want it if they know what it does for them. And he's saying, well, explain this to me. And that's where I went into the toilet paper scenario. And I said, okay, let's pick a product that you need. Toilet paper. Go down here to 7-Eleven. It's about $5.70 a roll for one roll. Okay, it's Angel Soft. It's nice. It comes all individually wrapped.
2-ply.
2-ply. It's
Okay.
nice stuff. It's
That's
good stuff.
the key.
$5.70 a roll.
Highest
Yeah.
of quality.
I was like Christmas Day
The
when you run out,
Cadillac.
you got to go down to 7-Eleven. Right? And I said, or you could pay 70 cents a roll at Costco, but the catch is you got to buy 30 rolls. And the guys just look at me. I go, what you're doing is you're simply saying that your clients have enough money. They don't need long-term care
To
insurance.
spend the money.
It's the same as saying, congratulations, you can't shop at Costco. You can only shop at 7-Eleven for everything moving forward. Well, why? Well, because you got enough money to pay for that. There's no reason why you should be not, you don't need to go to Costco and buy your toilet paper. You can afford it at 7-Eleven. I go, your clients aren't going to do that. Go to Costco. It's not a bunch of clunker cars in the Costco parking lot, right? Those are people that appreciate value. They appreciate the efficiency. They want to protect their money. And so that wealthy segment has just been ignored because we've tried to simplify that conversation as long-term care is just about money. Okay, well, what about the tax savings? What about the efficiency? What about the guaranteed leverage? The tax savings in so many ways. How happy is your client to know when they just went up 3 levels on their cost of Medicare because their adjusted gross income just went up? So those are the conversations that if you ask a wealthy person, Bill Gates, I don't know what his house is worth in Medina, but let's say it's $50 million now. It's probably gone up in value. That house burns down. He could call a contractor, get it rebuilt, and he could pay for it out of his pocket. It'd be like you and me pulling out a quarter out of our pocket. It wouldn't bug him, but I guarantee he's got insurance. Because wealthy people, why would you pay to rebuild something like that when you can let the insurance company repay that?
Right.
And on these asset-based plans that we're talking about now there's the argument was always like, well, it's a waste of money because they're probably not going to use it. Okay, it's not a waste of money anymore. They're going to get all their money back, maybe a little bit more money back, depending on how we design it, tax-free. And they've got the leverage if they need it.
Yeah.
And they've got the tax savings if they need it.
So let's double click on that and drill a little deeper into that. So you apply you and your practice and the solutions, the clients that you're visiting who are higher net worth,
Okay.
more affluent, and what are some of the initial challenges that you're seeing in those conversations, and what approaches have you taken?
So one of the biggest hurdles, why hasn't somebody else told them about it? Why hasn't their financial advisor told them about it? If this is so good, how
That's
come
a
I haven't
great
heard
point.
about it before?
Yes.
That's a very big obstacle for me. And I'm very clear with them. If we look at the general population, over 4 to 5% of the people pay for long-term care insurance.
That's a great point, because they trust their advisor. How
That's right.
come my advisor, who's done such a great job for me, has not ever brought this to my attention?
Yeah.
Because you're telling me about this?
And if we look at those financial advisors, they're not any different. Probably less than 5% of them have long-term care insurance. So how am I going to get you amped up and sell you on something that
I don't believe in.
I don't
Or I
believe
don't
in,
know.
or if I if I do think you need it, but I don't have it, how does that play out?
Right.
Well, what are you doing? Well, I'm self-insuring. All right. So I think that's a big obstacle. And again, that comes from a lack of education, right? Okay.
So how do you deal with that?
Well, that's the education, right? So what we've done really well is we've continued to educate our clients through our podcasts and through our videos on our website and things like that about what long-term care is. Just what it is, how it works, what your options are, what it pays for, what the government doesn't pay for. And here's some examples. And we do a client of the week every week on our podcast. And that's just an example of somebody that came in, what we talked about, what was important to them, why they started looking at it in the first place. And what we found is that there's a tremendous amount of people that are interested in learning about long-term care, but their advisors have just always told them, you're okay, you don't need to worry about it. And so some will feel guilty going behind that advisor's back, and then others will just say, no, I'm going to go learn about it and do it, and understand that they're really going back to our beginning conversation. How do you become a specialist? Okay, let them manage your finances, let them get you in the real estate investment trust, let them do all those things, but let's work with an insurance professional on the insurance. And so when these wealthy people find out, when you show somebody, hey, how much are we going to set aside? Well, they statistically say $250,000 per person in retirement is going to be your unpaid medical costs, which is basically long-term care. A little bit of prescription drugs, but mostly long-term care. That's what your risk is. Well, that's $500,000 for a couple. What if we took half of that? And it turns out that, well, we can triple it automatically on our simplest plan, or we could even give you a lifetime of coverage. And oh yeah, you're going to get that money back if you don't use it. And wait a second, it's a stopgap. And one of the things I think, Scott, that we talk about, going back to language, you know what we're doing with asset-based long-term care plans? We're still self-insuring. Because when I give $200,000 to the insurance company and then I go on claim, what are they doing? They're giving me that $200,000 back first.
Right.
It's just that's the stopgap. It's a better way to self-insure, because if you do that, your next $200,000 is still your money. And the 200 after that is still your money, because now you're using insurance money. And that's really just those little scenarios. Well, I'm going to self-insure. Well, you are self-insuring with an asset-based plan. It's just a better way to self-insure. Well, what do you mean? It's like, well, you reposition this money, you're going to get all of it back, maybe a little bit more guaranteed, but should you need care, you get this leverage and you get all these tax advantages and you get this access to these professionals.
You know, it was at the very beginning of that, you said the biggest thing we start with is education. And I think that is the biggest downfall of all advisors, of all consumers, when it comes to planning for long-term care. Advisors don't understand the general basics. What is long-term care? What are your options? All these different things, right? And then that trickles down to the consumer base, the entire public consumer base, not just their clients, all throughout the country, there is a lack of knowledge of what is long-term care, what are options, unless they have personal experience through taking care of a loved
Bingo.
one, family.
Bingo.
Then they're like, holy cow, I need to go find out about this long-term care,
Yes.
right? And how I can protect against it so I don't have to be a burden on my kids.
Yes. And Nick, that is such a valid point. I will just tell you that 75% at least of all my clients have had some personal experience with long-term care, at least, and maybe more. That's why they come to us. They watch their parents go through it. I have a gentleman that has a lifetime benefit plan, robust plan. I mean, starting at $15,000 a month, he's got inflation on it. He put a big chunk of money into this plan. He watched his parents go through over $3.5 million. At this time, his parents are still alive. Dad, 13 years in care. Mom, going on her 9th year. They're in 2 separate Medicaid facilities.
No.
He's a retired CEO of a company. He's got money. He goes, people don't understand what this can be. And it's not meaning that it's going to happen to you, but it could happen to you. How do you mitigate that?
Right.
Right. So that's what he's wanting to do. And so the people with experience, or the other thing that I really get a lot, and so let's just take money out of this. What are the benefits of having that long-term care plan? Well, one of them is you have a plan. Your house burns down. You don't jump on the internet and start looking for contractors. You call your insurance agent. Oh, I'm sorry about that. Yeah, then we'll come out, and they get their clipboard out and they start taking notes. Well, insurance has built that in through, they've got this claims process, claim support, case management. They know how to, these are people that have been to the rodeo before. They know how to speak the language. They're there to help you and your loved ones. Your loved ones don't know what's going on. So I flew out here today. I was sitting next to a guy that runs the head of nursing at Swedish in Seattle, and we were talking about what we do, and he's like, because I was just saying like how overwhelming it is for family when all of a sudden there's an emergency, mom's in here, and then when mom's got to go to this place, and then mom needs care for here, and he goes, they don't understand what we're talking about or how to find that help or do that. That's the crisis part of it, and long-term care is no different. So people with experience that have watched mom or dad go through it, it's a lot more meaningful to them. And also, from a financial point of view, that obstacle of I'm not going to need it, I'm wasting money. Well, now we're softening that a little bit because you're not wasting your money, you're repositioning
It's reality,
it.
yeah.
Look what it does for you.
Yeah.
Look what it does. And that's that education piece.
That's great. Any other questions for Brian today before we wrap up?
That's a great way to start is like I was saying, educating clients and for me, educating advisors on it, right? That's step one. If you want to be more successful in it, you got to get the education.
Yeah.
Yeah, and you have to have an open mind of understanding that, things change and they evolve, but what are the real issues? And what I'm learning now is we're getting people on claim now. Okay, that initial, the house burns down. Like my house burned down as a kid. The initial stress right there isn't like how much is it going to cost me to rebuild the house. The initial stress is like, where am I going to sleep tonight and tomorrow, and how am I going to get food and all those things. Long-term care is that same way. When a sudden event happens, it's not like how much is this going to cost or who's paying for it. It's like, how do I get the care? Hospital's telling me I can't stay here anymore. I got to go here. We have a lady on claim, 91 years old, no kids, no spouse. Her brother just passed away. She wakes up in a hospice center. Her biggest theory or issue wasn't how much is this going to cost or where it goes. She goes, I shouldn't be here. How do I get to? I've got insurance. How do I get back to my home or to a facility? I don't want to be in hospice care. So those are all those things that come with having a plan. It's not, when it hits the fan, you don't just jump on Google and be like, oh, mom needs assisted living. She fell last night. Mm-hmm. Oh, here's a good one. We'll send her there. We'll have Uber come pick her up. It doesn't work that way, right? It's full hands-on. So then on top of that, everything you do costs money.
Right.
And that's where those expenses start coming in, piling up.
Nicholas, Brian, thank you for coming in. Until next time.
Awesome. Thank you.
Until next time.
Thank you for tuning in to today's episode. Please subscribe, like, share, leave a comment or review. Be sure to check us out on social media at Optimized Advisor Podcast. Till next time.